Leo has been investing for 2 years. He checks his portfolio every single day, sometimes before he even gets out of bed, and every time the market dips, even a little, he sells, not because he needs the money, because watching the number go down feels unbearable. So he gets out, waits for things to calm down, then buys back in when it feels safe again. He calls it being smart, being careful. He has no idea it's the most expensive habit he has. Leo started investing at 26, watched a few videos, opened a brokerage account, put in $200 a month into a simple index fund. Solid start. Better than most people his age. For the first few months, everything felt good. The balance was climbing. Small, but climbing. Then the market dropped. Not a crash, just a normal dip. The kind that happens several times every single year. But Leo didn't know that. All he saw was his balance, down $400 in 1 week. His stomach dropped with it, so he did what felt logical. He moved everything to cash, just until things settled down, just until it felt safe to go back in. Here's what Leo didn't understand. The market doesn't announce when it's done falling. There's no signal, no green light, no moment where everything feels obviously safe again. So Leo waited and waited, and while he waited, the market recovered fast, the way it usually does after a dip, and by the time Leo felt comfortable enough to buy back in, he had missed the biggest recovery days of that year. Because the biggest recovery days in the market almost always happen right after the biggest drops. The moment Leo sold to protect himself was almost exactly the moment he should have held on tightest. The real cost. Let's make this a number, because numbers make it real. Over a 20-year period, if Leo kept investing $200 every month and stayed invested, his money could grow to around $150,000. But the difference comes from something most people underestimate. The market doesn't usually make its biggest moves when everyone feels confident. Some of the strongest recovery days happen right after the moments when people are the most afraid. So when Leo sells during those scary moments, he's not just missing one good day. He's missing the days that push the entire investment forward. Over time, those missed days create a massive gap. Same person, same money, same 20 years, but one person stayed invested, and the other kept stepping away at the worst moments. That gap doesn't show up immediately. It shows up a decade later, when Leo looks at his account and wonders why the number doesn't match the years he put in. Leo didn't do this once. He did it every time the market moved in a way that made him uncomfortable. And the market made him uncomfortable a lot. Because that's what markets do. They go up. They go down. They go sideways for months and then jump overnight. Every time Leo saw red, he sold. Then he waited for things to feel safe again. And by the time he came back, prices were usually higher than when he left. He wasn't avoiding losses. He was turning temporary drops into permanent mistakes. Not because he was reckless, because he was scared. And nobody had ever told him that scared is the most expensive way to invest. The turning point. 3 years into this pattern, Leo sat down and looked at his actual returns, not his balance. His returns, he compared what he had to what he would have had if he had never touched the account. If he had just left it alone from day one and never sold a single time. The difference wasn't small. It wasn't a rounding error. It was the kind of number that makes you sit back and stare at the ceiling for a while. And what hit Leo hardest wasn't the money. It was the realization that he had been working hard for 3 years, putting money away every month, being responsible, doing what he thought was the right thing. And his own fear had quietly undone most of it. He didn't lose money to a bad investment. He lost it to himself. Later, Leo realized something frustrating. The people who built wealth weren't people who knew exactly when the market would fall. They weren't predicting the future. They just had a plan they refused to abandon every time emotions got loud. When the market dropped, they didn't see a reason to sell. They saw everything on sale. When everyone else was running out, they were the ones quietly staying put, sometimes even adding more. Not because they were fearless, because they understood one thing Leo didn't. You can't build long-term wealth with short-term reactions. The market rewards patience the same way it punishes panic, every single time. Leo stopped checking his portfolio every day, not because he stopped caring, because he realized that every time he checked it, he was giving himself a chance to make a decision he didn't need to make. He set his $200 monthly contribution to automatic. He stopped watching the daily numbers. And the next time the market dipped, because it always does, he didn't sell. He didn't move to cash. He didn't wait for it to feel safe. He just left it alone. And for the first time since he started investing, his money actually had the chance to do what money does when you stop interrupting it: grow. Most people who lose money in the market don't lose it to bad stocks or bad timing. They lose it to the version of themselves that couldn't sit still when things felt uncertain. The market has always recovered from every single drop in its history, every crash, every correction, every moment that felt like the end. It came back. The only people who didn't benefit from that recovery were the ones who sold before it happened. So the next time your portfolio goes red and everything in you wants to do something, remember that doing nothing is a decision too. And sometimes it's the most profitable one you'll ever make.